Folks, you know the drill. This is not investment advice, just a couple of dudes discussing our favorite technologies in the Web3 space. Also, given our conviction, we have beneficial financial positions in these technologies as well.
Okay, recording has started. Hi, folks. Welcome to our first and hopefully not only episode of Cryptoversation. We have Krishna and this is Sharad. And we're trying to walk us through, I guess, some of the trends that we are seeing in the crypto space, the reasons why we are involved now, and why we think a lot of people, retail investors, should get involved in the future. So this is going to be like the crux of this conversation, and I think a lot of the conversations that follow. Welcome, Krishna. Uh, as always, awesome to have you here.
Hi, Sharath. Hi, everyone. It's great to have our first session. We can't be more excited to get started.
Awesome. Hey, given this is the first, I think I want to sort of give you an easy question to get you the spirit warm up. So I'll talk about the very first time, I think, when we started talking about the crypto space and how I was like, oh, this is all a scam. I wouldn't want to get in. And I think you brought up this thing like everybody should be invested into crypto at some percentage of their portfolio, right? Whatever that might be, depending on your risk appetite. So maybe walk me through and walk some of our audience through this, right? Like, what is that conviction? Why should everybody invest something into crypto of their portfolio?
Yeah, great question, Sharath. Yeah, so I do remember the first conversation that we had, and given that space is murky with so much bad information and news about so many bad actors, and also the other part is because it's so nascent and moving at a rapid clip. The first gut reaction is, oh my God, there is one more crypto guy talking about crypto space. so, that doesn't surprise me that majority of the people who come or look at the crypto space just write it off on the face of it. But when you look underneath the hood, what differentiates crypto or I would say Web3? I think Web3 is a better nomenclature. So moving forward, I'll try to use Web3. One, to dissociate with crypto. Crypto is nothing but just cryptography, which has been widely attributed to all of this space. So everyone started calling it as crypto. So I'll start addressing Web3 moving forward. And the difference that Web3 offers from Web2 or the internet as we know today is it gives the ability for us to put assets in a native digital form. I know that's a mouthful, but we will expand that in the rest of the episode. So essentially, you are creating a new fabric where you can create, transfer, and then trade different assets. These assets can be representation of physical ones, or they can be assets that live and exist and expire in the digital world, in the digital realm. So given this is a new fabric and it enables all of these use cases, all the different use cases that we can't even foresee, I would compare this being analogous to something in 1990s. So if you ask me, or if you ask a generation prior, hey, what is the sector that you have to get exposure to? Unanimously looking back, we would say it is Web 2.0. In 1990s, everyone has to have some exposure to the internet companies. So with the same mindset, I mentioned to you that, hey, everyone today has to have exposure to Web3. So that's the gist of what I said with all the things in the background.
Yeah, that makes a lot of sense. That said, why do you think, like, what do you think, I guess, how would people think about what percentage of my portfolio should be in this, right? Like, I guess going back to the 90s, it would have made sense to have like all of your money in Web2 at some point. But given today and given what you have as conviction in the space, like, what do you think is a good percentage? How should people think about a good percentage there, actually?
Yeah, I'd focus this discussion or the next couple of minutes of my talk for large swaths of people or general population who have some basic understanding of what this space unlocks. But I wouldn't be talking about someone who's actually in this space and spending time in this space, someone like you or me. So for the large majority of the population, even if you let's quickly go back to the 90s. Even during the 90s, although there are a lot of internet companies, it was extremely hard for you to decipher Amazon versus Pets.com. Pets.com was the name in town. It was the company where it was going up 20% every other day. It sucked in a lot of VCs. It sucked in a lot of retail. So during that era, it's hard for you to make a case that, hey, someone has to have substantial part of their portfolio in Web 2. Reason being, the ability for someone who's not really working in Web 2 or not working in one of those companies to have an understanding of what is being built, how is it growing, it's extremely hard. So even in those cases, I would say that for someone who's like, if you go back 40 years, I'd say the exposure that you can have to this space is like 1 to 2%. What that does is those 1 to 2% would not adversely affect your portfolio much. However, given the exponential growth that you have in the nascent sector like internet in the 90s or the Web3 during this period of time, that 1% can easily do a 10x to 20x. So which becomes a meaningful part of your portfolio. So I think for someone who understands what this space can become, but do not have the time or is not spending the time in understanding day to day to separate out which has staying power, which are real use cases versus which are dressed as real use cases, um, I wouldn't recommend them going more than like 5 to 10%. It's extremely risky. There is a lot of chaos, and one of the other things is, even if you have identified good use cases, you might still be early and it might not pan out. One of the best example is the company that's being sold by um, Mark Cuban. It's an early Netflix, right? Like he sold the company, but the company did not go anywhere. The idea in itself is possible after 20 years, but the infrastructure has to catch up. So
That's right,
it
yeah.
doesn't have to always be the case that um, it's always frauds versus not frauds. Even if you have identified a legitimate use case, the
Correct. You
market
have
has
a
to be
fantastic idea, but the execution might
yeah,
not suffer.
and even the infrastructure in the market has to
The
be
market
ready.
needs to be ready to. Yeah, that makes a lot of
Yeah.
sense. Yeah. So I guess we didn't answer. How should people think about what percent of their portfolio is in there? I guess summarize what you've been saying is this changes from person to person and their risk appetite. But
Yeah.
the way you should think about it is no bet is a sure bet. And
Yes.
so sort of diversify and spread your risk, try and hedge.
Yes, yes, but I would say that given the exponential nature of the space itself, having some exposure is absolutely key and vital if you want to um, gain um, the upside that is possible by identifying the space. But at the same time, the line of being irresponsible gets really blurry if you start going above 5%, if you're not spending time active in the space. So I would say 1 to 2% generally across the board is good allocation. 5% you would want to spend more time. 10% I'd say you should spend time in the space, significant time in the space.
Got it. So that actually is a great segue to the next question I was thinking about. Most people, traditional investors, most mom and pop type of investors, retail investors, are set it and forget it type of people, right? So
Yeah.
what they're looking at is investments where they sort of make their investment and then it accrues a certain rate of return over a certain period of time. It's steady, it's somewhat predictable, and they don't have to constantly worry about it, constantly rebalance it, constantly take into it, and sort of maybe like buying an ETF, like buying into the S&P 500 or something. It would be a preferred mode, and that's where you see a lot of people's big money, right? So your 401ks go there, your mutual funds go there, things like that. So, or it goes in real estate, for example, where you probably put a huge down payment on a house. So then for those people, then your prescription is set and forget about 1 to 3% of your portfolio into the Web3 space. Now,
Yes.
how would one go about doing that, right? Like, what should you do to set and forget, I guess?
Yes, great question. The ideal way is to look at coin market cap and identify the top 10 coins, assign that 1% based on that proportion minus all the stable coins. I'd say there will be duds even then in those, but the winners will make up for all the losers and much more. So this is kind of like your index strategy where you look at the S&P ETF, S&P 500. Let's say Apple is like 5% or Microsoft is 7%. So in that proportion, the ETF allocates. In a similar way, you can construct a portfolio for yourself where you can rebalance once a quarter or once in 6 months. That still works. So as of today, let's say Bitcoin is 58% of the market cap. So $58 of every $100 that you invest goes to Bitcoin. Let's say the Ethereum, I think, is the next biggest one. Some $20 goes to Ethereum and so on and so forth.
That makes a lot of sense. I know that Bitcoin and hopefully Ethereum in the future will have ETFs, and so it makes it really easy for most people to invest. But how do you go about, I guess, doing something like this? Like I wanted to put, say, $100 of my paycheck every month or every paycheck, every time I get a paycheck into this and distribute it accordingly. Are there some ways to execute that like a strategy and just like keep doing it like you would do?
So you're asking something like a systematic investment plan. Are there any SIPs in this space?
Correct.
I am not entirely sure of an SIPs to do the ETF kind of strategy. There are some use cases, some applications that I've seen which offer SIPs into specific coins. But I'd say the easiest if you are in US is to get a Coinbase account and have some exposure. So yes, because like I mentioned, the nascency of the space, you will have some legwork or some work that needs to be done. That is rebalancing once a quarter or once in 6 months. Actually, once in 6 months is also should work. You don't have to do it every quarter. So as long as you rebalance your portfolio every 6 months, I think it should be okay. And you can even pick the top 5 coins. You don't even have to go below top 5. And then remove all the stable coins. Stable coins are coins that are representations of USDC. There is USDT, there is USDT, the Tether. So you can just remove them. I think there will be 2 of them out of the 5, and you can allocate based on proportion just in Coinbase.
That makes a ton of sense. It's also a fantastic segue into. I think I've struggled myself before. We had some lengthy discussions on this topic, and I'm sure a lot of our viewers might be struggling with this concept as well. We know Bitcoin is valued at some value, but today it's at 66,000 while we are recording this. But I guess people don't understand that value proposition itself of why this should be $66,000 and whether there's some fees. How do we traditionally value this? Like if I was valuing it like a company, what's the revenue? Why does it deserve this market cap, etc.? I think most people struggle with that concept, and you had a very, I would say, beautiful analogy and explanation to this. So could you maybe repeat that for the benefit of everybody and for me to revise my faith in the product?
Yeah, I think it's important, Sarath, for us to actually separate out. Like Web3 is this whole new space, and within Web3, different coins enable different use cases. So first, I cannot shout this message loud enough from the top of the hill. The reason I emphasize that is because everyone understands gold is different from a company, let's say Tesla, right? No one even thinks that, hey, Tesla and gold are Web2. They're not. But however, when someone talks about crypto, they just start comparing apples and oranges, or they start bucketing all of them together. That really colludes the understanding of what's happening under the hood. So let us quickly talk about the biggest one in the Web3, that is Bitcoin. So Bitcoin, the best way to really understand and make sense of this is it's a digital version of gold, which has fixed supply, period. That is the best way to think about it as of today. Again, there will be some different developments, experimentation that are going on top of Bitcoin. We do not have a product market fit yet that is proven for consistent period of time. The reason I say that is because right now there is a lot of experimentation that is going on Bitcoin in terms of runes. There is a lot of money that's being sloshing around, but we will know if that is a sustainable long-term use case for Bitcoin in a year out. But so far, I would say the best way to think about this is if you have a digital version of gold that you can hold without help of any third party. That is what Bitcoin is. And unlike gold, whose supply goes up every year close to 2.5%, Bitcoin's, the total supply cannot exceed 21 million. And it's a fixed supply asset. It's a digital version of the gold. And one other thing, I think why Bitcoin becomes really powerful is throughout humanity, whenever the humans have to escape their countries or had to leave their assets, the only big asset that they could carry with them is gold. And for once, with the unlock of this Web3, there is an asset called Bitcoin, and all you have to remember is your mnemonic or the 12 words, and no one can take your assets away from you. So that, I think, is a really big unlock that this digital native asset gives you, because gold is heavy, gold can be stolen, there's a whole bunch of problems. So that offers this schmuck insurance, if you can say that. So that, I would say, is the biggest use case for Bitcoin today. Now, how do you value it is subjective, I would say. It's hard to put a number to it. Like, how do you value gold? Uh, Gold is valued by how someone else is willing to pay the price for that gold bar. So it is similar to Bitcoin because there is limited supply and everyone understands the use case. Everyone understands that you can self-custody. This is a way to store your wealth. If you have devaluing local currency, you might, like, for example, you're in Argentina or you're in Venezuela, you might want to have a fixed store of wealth. It used to be US dollar for so many countries, but with getting access to dollars becoming incrementally harder, Bitcoin has become a really good alternative for especially these emerging nations. So that, I would say, is Bitcoin and Bitcoin alone. And everything else is a different story. So do you want me to transition there, Sarath, or do you want me
no?
to?
So let's
Yeah.
think about it for a second here, just for the
Yeah.
for the Bitcoin volume graph. So it is similar to gold in that it's a store of value. It is probably, there isn't like a modern day functional value to it yet, in the sense, just like gold, like you probably use it in jewelry, but there's not much else you do with it, right? So it's just a store of value. You put it in a bank somewhere, you could. Now, I think where the disconnect happens is most people don't think about how gold is valued at all.
Yeah.
And so as a consequence, it's hard to wrap your head around how Bitcoin is valued, especially when you see these like really large numbers, right, of a
Yeah.
digital nature. So I think maybe is it worth probably taking a second here to dive into saying more than what is someone willing to pay for it? What other push and pull factors sort of jump in and play a role in it becoming whatever it is? I think how was the world convinced to pay $16,000 for this? I guess that's a big
Yeah.
one.
Yeah, great question. Actually, there are two aspects to this. Like for any commodity, the price of a commodity is completely determined by the demand supply dynamics. So if the supply increases or supply ratchets up, right, then you see the price collapse. The reason gold has held its value is because of the limited supply that humanity was able to add to the gold pile that we have over thousands of thousands of years. One of the examples that we have very concretely documented is in North Africa. Their currency used to be seashells. So there is a European country which actually took ships of seashells and dumped their seashells for their local gold. And you can know what over a period of time the inflation became so high because there was so much supply increase of seashells. Their a whole local economy had to reevaluate or move away from seashells. This happened with every single currency in history where the currency supply could be inflated. This happened with copper coins, this happened with silver coins, all of this because the amount of supply that you can add to the existing pile is way higher than what is existing. The reason I'm explaining these stories is because the price is made on the margin on how much supply is available for the new purchases. If there is not enough demand, but there is excess supply, prices collapse. So in the similar way, because there are only 21 million Bitcoin and then there are 7 billion people, as as the supply keeps reducing. When I say supply, the amount of bitcoins that are being sold versus the number of buyers that keeps increasing over a period of time as people more and more.
Or even minted, not even sold. Like, the number of bitcoins being minted as well and back into the market. It's also a factor.
Yeah, the number of Bitcoin, we didn't talk about that, but I think it's
Well,
important that
while we haven't hit the cap yet, so we are adding a steady supply, I guess, to the market. Just like gold, we are adding like 2.5% every year to your point. We are adding some percentage of Bitcoin every year right now.
That's true. That's true. So as long as the demand outpaces the supply, the price keeps going up. And as we move forward, the demand might further ratchet up. So the price might further shoot up. And one other thing I also like to highlight about Bitcoin is, although everyone thinks that, oh, one Bitcoin is $67,000 or whatever the current price is, a better way to think about is each Bitcoin is divisible into 100 million Satoshi. So we will get to a point where we talk in Satoshi rather than a whole Bitcoin. You don't have to own a whole Bitcoin. You can have one by 100 million of a Bitcoin. So that is how the system itself is designed.
Correct. Yeah. So
even the block rewards are actually given in. Even the block rewards are allocated in the number of Satoshi, not really in Bitcoin. So that's why I wanted to make the distinction.
Got it. That makes a lot of sense. And for our viewers who are probably unaware, if you are unaware, Satoshi Nakamoto is the pseudonymous founder of Bitcoin. Don't know who he is, and hopefully we'll know soon. Awesome. Thanks. So I think that is a brilliant explanation. So when it jumps in to this like current events, right? Suddenly, we've talked about value. This was very funny when that happened just yesterday when we're recording this podcast, the Bitcoin halving, which is when supply for each block sort of cuts in half for successfully finishing each block, I guess. So I guess, and you've talked to me before about this. We typically see certain price action around the halving, before and after it. We've seen Bitcoin typically, run up, have very strong bull period after each time it has happened. Now, if normal supply demand were in play, if half the supply that is added to the market, you would expect a certain price action. But it sort of exceeds all those expectations. The price action is very asymmetric. It's quite parabolic, to use your word. So how do we think about that? How is that explained? I guess, why does the world suddenly discover this product over and over again every 4 years?
Yeah, I think that's a great question, Sarath. I'd answer that in two parts. First, I think it's maybe it'll be helpful for us to take a step back and just tell the viewers that the creator of Bitcoin designed the system. We don't know if it is the best system or the most effective way for coin distribution. It is a mechanism for coin distribution, and it is even called a fair mint process, where anyone can start mining for Bitcoin. Mining is essentially you help contribute for the security of the network, and in return, you get rewarded for contributing to the security of the network. So every 10 minutes, initially, first few blocks, a bunch of coins were allocated randomly to a chosen node. I'm deliberately avoiding the nuances because it gets really technical very fast. But the gist is, every single coin has been mined. None of the coins were pre-allocated to anyone. So the only way to get coins from the network is actually participating in the network, providing security to the network, helping the network be more resilient. So that is how the system is designed. And as you referred some time back, that the halving just took place. So every 4 years, the protocol has baked in that the number of coins that are awarded as a reward for providing security for every 10 minutes or every block, it's called block reward, that gets reduced by half every 4 years. It's actually 210,000 blocks. That roughly translates to 4 years. Yeah. So now the question that we have to ask ourselves is every 4 years, why is that a surprise? Like, why does the whole world wake up for this halving event? That's a great question. So the first part is it used to be a meaningful difference because if you were actually mining in the first 4 years, the number of bitcoins that were awarded to you was significant amount. You used to get a whole bunch of tokens for every block, and now based on that, in order to stay competitive, in order to make sure that you are winning that particular block's reward, you start ratcheting up your infrastructure, you start ratcheting up your expenditure on um,
So you
power
have to
consumption.
invest more in sort of mining, for the lack of a better word, each block and each coin that is
Right,
put up.
right. Yeah, the better hardware
And
you have,
to
the
to be
more
clear,
yeah.
for us to wrap our heads around it, the very first years when Bitcoin was introduced, right after the financial crisis, I believe, what was the block award at that point? How many coins?
I think it was 50 Bitcoin.
Right. Okay. So
Yeah,
we started about 50, and now we are hitting about 3.125. So
yeah,
even if the expenditure and the costs of providing the security or mining remain the same, because Bitcoin itself has gone down by what, 50 to 3.125, whatever that percentage is.
yeah, yeah.
The price has to at least jump up by that much to just break even had the difficulty been the same. Is that fair?
Yes,
Right.
yes,
Okay.
that's right. Had the network security been the same.
Correct.
Right.
And over the course of this time, since 2009, I believe, I think what big changes have like, why has this become exponentially harder to mint? Like,
Yes, great
what is it
point.
costing?
This is exactly, yeah, the mechanism that I was talking about has this surprisingly, I wouldn't say it is even surprising at this point. It just is, it just banks on the ingenuity and the nature of humans to be greedy, to really be enterprising. I mean, greedy and enterprising at the same time,
Yeah.
in order to, yeah, so you start innovating on different ways on how you can better mine the equipment. You start optimizing your hardware. You start going to sources where the energy is extremely cheap. You'll start exploring where are the remotest places where I can get energy for near $0. So all of this happened in the last 10 years, which is amazing if you just go back and look at the kind of innovations that happened. Whereas when it started, to your point, people were actually mining in a consumer grade hardware, like literally a CPU, maybe not even 4 cores. They literally have 1 core CPU that people are mining. To today, you need to have custom FPGA chips that were built for Bitcoin, and there is no guarantee still you might be able to win the block reward if you contribute for 4 years straight with one machine. So you transition all the way from there to here. So I would say the network security has gone up by more than a million times, the whole network security. So
And in terms of, and I think you started off with this point, which is the only way to participate or get coins is to participate in this network, and only the people that have the coins will be able to add to the market, sort of sell and
yeah,
demand a price, so to speak.
yeah,
So, and if their costs in acquiring this coin went up, they would ideally demand a higher price, and therefore, at every halving event, the price is expected to go up. Now, coming to the second point, then, why is there more participation that happens around this? Like, because the price is expected to go up 2 times each time it halves, or 4 times. That makes sense to me. But there's also increased participation, it looks like, that is causing the demand to spike significantly each time. So is it just a news cycle? Is like, why are more people coming and trying to buy these coins?
there are two parts to it. I talk about the fundamentals first, and then I'll talk about the speculation as well, because there are two aspects to this. The fundamental thing is whenever you have this block rewards, and because this is a free market, there are different miners who are starting to compete, who are ratcheting up the innovation cycle in order to see, like, hey, can I get a better hardware? Can I go to the a better, cheaper resources? Like today, we are using the flare-up gases from oil and natural gas refineries. We are even going to Ireland, where there is hydropower that's really cheap. We're doing a whole bunch of things. Now, when you optimize your machinery, when you optimize your operations, when you optimize all of your equipment and everything to the T, and suddenly this halving event happens, and then the number of rewards that you get really cuts down by half. What happens is, like 20 to 25% of the miners become suddenly unprofitable. For this to really adjust then these miners will go out of business or they sell off their equipment. And then there is an adjustment cycle that happens across the whole miner community, like the equipment that's being
Sort of
sold.
a consolidation in traditional markets, like the
Yes. So even though it is predictable, it is a hard line to cross. Today, you are getting, let's say, 100 coins every month, depending on how small a miner you are. But tomorrow, you start analyzing that, okay, after 4 years, you might get 50 coins, right? However, once you start predicting for that, you might start becoming not so competitive in this 4 year cycle itself. So it's really hard to just look your ecosystem in isolation. It also depends on what other miners are doing. So all of these factors, even though you know when the Bitcoin timing is going to be half, because of the competitive landscape, everyone tries to ramp up, everyone tries to innovate as much as possible. So that is one reason this whole consolidation and the supply shock um, drives the prices. But there is one thing that I'd like to emphasize, Sarah. This event itself is a non-event, to be honest with you. Uh, every halving, at least on the previous cycles, it takes at least 4 months to 9 months for the Bitcoin price to reach all-time high after the halving event. This is an anomaly. This cycle is an anomaly. So actually, halving itself is a non-event from a price standpoint, because, like I told you, for the supply shock to actually be felt by the miner community, that to ripple through all of the ecosystem, it takes some adjustment time. And then even if you have, let's say, the constant demand, you see the price has to readjust based on the halving that happened. Now coming to the speculation part. So now, every single time you see Bitcoin hitting all-time high, two times the all-time high, or three times the previous all-time high, it rejuvenates and re-energizes a lot of people. It brings a lot of attention. You see CNBC and all of these news channels talking just about Bitcoin. This further accelerates the demand. It further accelerates everyone's attention. Attention is money in this day and age. So everyone is looking at it. And
so it's sort of a self-fulfilling prophecy in that sense.
Every cycle, yes. And once you have all the marginal buyers buy, and that typically marks the top, and every cycle also has a top when the speculation front runs everything else.
That makes a lot of sense. Thanks. So we are almost at time, but I think I want to pursue this one line of questioning because I think you made a really good segue there. So, well, what is your outlook then for these next 3, 6, 9 months, right? Of post this halving event right now, standing where we are today, knowing what we know right now, what is your outlook? And when you think of, you've been in these multiple of these cycles. So when you think about the last time this happened to now, what's same and what's different, I guess?
Yeah. I'd say what's different is how mainstream Web3 has become. I think this cycle, we have an ETF, we have a traditional way for us to get some exposure even through our retirement accounts to Bitcoin. I think it's a massive change. And from the last cycle, I think one other event that I felt went under the radar is Bitcoin has been used as a treasury asset for Fortune 500 company, micro strategy, right? And everyone thought in the bear market or during when the prices collapsed, the company would face really hard times. But turns out they have done really well. And even a third world country has put Bitcoin on their balance sheet. So I think the experiment, even though it doesn't get much news coverage, I feel that in this cycle, there are examples where it is showing to be a very resilient asset. It's something like if someone puts gold on your corporate balance sheet, is it that different? It can be considered as a diversification play. It can be considered as an insurance policy, right? So I think that is really, really different. And the second thing is institutions have realized that Web3 is here to stay. And Web3 enables this digitization of assets, the line that we opened up with. And we will see more use cases, more experimentation this cycle. I think that is a welcoming change. These are some of the major differences from the previous cycles, I'd say.
It's definitely gone mainstream. That's the takeaway for my US. Yeah, awesome.
For sure.
Cool. Yeah, and then what do you think the next quarter, and then at 6 month or 12-month period looks like from here?
Yeah, sure. I think we'd have some sideways consolidation this time. Due to the ETF flows, there has been too much attention that's been drawn into the space. I think we have front run. So the price action has been relentless, which makes me scary. So I'd expect some consolidation or some sideways action for the next 2 months at least. Then we might, depending upon the Fed and depending upon the overall macro scene, I think we might have a good year in crypto assets.
Thanks. That was an amazing conversation. And signing off for now. Hopefully, we'll have a lot more of these. And next time, I'm looking forward to maybe talking about some of these other assets in the Web3 space as well. Bitcoin definitely had to be our first one, but we should definitely talk, I think, about some of the other exciting projects that are here in the space.
Absolutely. Thank you, Sarath. Thank you, everyone, for watching this and staying with us. Hope this was useful. Do let us know in the comments, or if you want anything specific to be discussed, we'd be happy to focus our some of the upcoming episodes on this.
And like, share, and subscribe, I guess.
Yes, like, share, and subscribe. Just getting started, guys.